Welcome to ING's Think Aloud, where we try to make sense of the world in the most unbanky way we can. In today's episode,
I will make sure that whoever gamble on this market will be ouching like hell. For those who would like to shorten the markets, make my day.
Saudi Energy Minister Prince Abdulaziz bin Salman has fired a warning shot to oil traders that even Clint Eastwood would be proud of. Those betting against the oil market will regret it. But it may take more than a Hollywood catchphrase to calm this market. A recent upswing in COVID cases and new lockdown measures to stem the spread of the virus have sparked fears that demand for oil will be hit at a time when supply is picking up. I'm Rebecca Byrne, and today I'm joined by Warren Patterson, ING's Head of Commodity Strategy, to find out if the recovery in oil prices since April is at risk and whether OPEC Plus may need to do more. Warren, there's growing concern about a second wave, particularly in parts of Europe, the UK and the US. How much impact do you think this is going to have on the demand for oil?
Yeah, clearly demand is still a big concern for the market. And it's safe to say that the recovery is taking much longer than originally anticipated. As you point out, a resurgence in COVID-19 cases is not helping. Well, we're seeing continued remote working and international travel remains crippled. So that's all dragging on oil demand. Saying that though, demand has recovered quite drastically from the lows back in April. So in April, during peak lockdowns, demand was down around 23 million barrels a day year on year. And currently it's estimated to be down in the region of around 8 million barrels a day year on year. So I don't believe we'll see demand starting to fall once again. And I expect a gradual recovery to continue. The reason I believe that is because I think governments will take a more targeted approach with any further spikes in cases. So instead of national lockdowns, they are likely to be much more localized. And we've seen examples of that both in the UK and in Spain. Now, looking further ahead and into 2021, demand is expected to jump quite significantly year on year, growing by around 6.8 million barrels a day. But given that demand on average this year is expected to be down in the region of 10 million barrels a day, it means that in 2021, global oil demand will still lag behind 2019 levels. And the key factor weighing on demand in 2021 is air travel. And I imagine we are unlikely to see that returning to more normal levels until a COVID-19 vaccine is commercially available. So I would suspect that if we don't see a widely available vaccine coming to market over the course of next year, then the growth currently expected in demand will be somewhat lower.
Right. In terms of the supply picture, OPEC has said that it needs to be more proactive and preemptive. And there's been speculation about an October meeting. Is that likely to happen? What sort of action could they take?
Yeah, the slower recovery in demand and recent price wobble will be somewhat of a concern for OPEC Plus. It's coming at a time when the group is gradually easing cuts. We've also seen non-OPEC supply coming back. And then it is also looking as though Libya is returning with supply to the market. Although I do expect Libyan supply to be fairly volatile moving forward, like we've seen in recent years. Now, there is a potential for an October meeting. I think given that these meetings at the moment are done virtually rather than in person in Vienna, the group can organize and act fairly quickly. As it is, we already have the monitoring committee of the group meeting on a monthly basis. For now, it's anyone's guess what they may do, but I believe they will keep on pushing for stronger compliance from members and also try and make sure that all those who have fallen short up until now compensate for overproducing. Clearly, if that's not enough, if demand does surprise, there is always the option for the group to revert to the deeper cuts that we saw between May and July. But then again, that's not going to be an easy task to convince all producers to get on board. So I think the final option they have is we could see some additional voluntary cuts from certain producers in order to help the market, much like we saw in June from Saudi Arabia, the UAE, and Kuwait.
Right. At the beginning of the podcast, we heard the Saudi oil ministers saying that whoever gambles on this market will be ouching like hell. Have we seen an increase in short selling recently? Are traders getting more nervous?
Yeah, that comment sounds more like desperation. And I think it probably highlights more that OPEC is getting nervous. We've obviously seen record cuts in recent months from the group, but prices have stalled in that $40 to $45 barrel range. Yes, in recent weeks, we have seen a lot more selling coming from the speculative community. So if we look at Brent, for example, the net long is basically at the lowest levels since late March, early April. It has predominantly been fresh shorts who have driven this reduction. So since July, we've seen about 100,000 lots of fresh speculative selling. The fact that we are at similar levels to what we saw back in April in terms of speculative positioning suggests to me that further selling should be fairly limited. The market outlook right now is nowhere near as negative as it was back in late Q1, early Q2.
So does that mean that we're not going to see prices fall into negative territory like we did back then? The market's obviously recovered a lot, but there's no risk that WTI could fall into negative territory. Was that a one-off?
I think it's unlikely, but never say never. The reason I think it's less likely is because we are not seeing the stock builds that we had back then. Demand is obviously stronger now, while US production is estimated at a little under 11 million barrels a day at the moment. Back in April, the US was producing over 12 million barrels a day. Then positioning in the lead up to the WTI expiry back then was a crucial factor for prices going negative. Certain longs were still active in the contract too close to expiry, and so had to exit their position basically at any cost or take physical delivery. I think those who do not have the capability of receiving or delivering physical oil learned a big lesson in April. And so since then, a large part of the market are much more reluctant to hold positions in a contract when we're nearing expiry.
Right. Another factor that's adding to the uncertainty in markets generally is the US presidential election in November. How much does the outcome of that election matter for the energy market? Because Trump's obviously been quite tough on trade with China. China's been buying a lot of US crude recently, seemingly to keep him happy. Does it make a difference for the oil market?
Yeah, the US elections could potentially have quite a big impact on the markets. Obviously, a Trump victory would lead to little change on the oil and gas side. But if we were to see a Biden victory, there could be a few changes. Clearly, China-US relations will be important for oil markets as well as broader markets. But there are also a couple of other changes we could see. One constructive for oil prices, and the other, I'd say, is quite bearish for the markets. So I'll start with the bearish one first. Obviously, under the Trump administration, we saw the US pull out of the Iranian nuclear deal and reimpose sanctions on the country. As a result, Iranian supply has fallen significantly over the last 2 years. So if we get a Biden victory, there's always the potential that that administration takes a less hawkish view than Trump has on Iran, which could see the US ease those sanctions. Obviously, if this happens, there's the potential for more than 1.5 million barrels a day of Iranian supply to come back onto the market over time. Then the other change we could see, which would be more supportive for prices, is further regulation on the US oil and gas industry, which could weigh on output in the longer term. There are suggestions that Biden would look to ban drilling on federal lands, and this would be quite significant given that if we look at 2019, around 24% of US oil output was produced on federal lands, whilst for natural gas that number was around 12%.
So putting all of this together, all the risks and all the uncertainty, where do you see oil prices by the end of the year and heading into 2021?
Yeah, so there's plenty of uncertainty still, particularly over how demand will evolve. But assuming we do not see a return to full national lockdowns, demand should continue to gradually improve. When you factor in OPEC plus supply cuts, this should mean the market draws down inventories in the months ahead. So that should be quite supportive for prices. Our view is that over the fourth quarter of this year, ICE Brent will average around $47 a barrel. Then as we go into 2021, we are looking at around $50 a barrel, whilst for full year 2021, we're currently forecasting an average of around $58 a barrel. This view depends heavily on demand, continue to recover over 2021, and obviously OPEC plus sticking with their production cuts.
Looking further ahead, Warren, do you think that the pandemic has permanently altered the outlook for oil demand. Earlier this month, BP said that global demand may never fully recover and may have already peaked. Would you agree with that?
Yeah, there seems to be a race to call peak oil demand at the moment. I think COVID-19 has clearly altered the outlook for oil demand. We could very well see some changes to how people work in the future, with remote working becoming more popular. However, I don't think we have hit peak demand just yet. As of yet, I don't think we are seeing strong enough government policy to drive this change. So, with a recovery in the global economy and with low prices, I think this should continue to drive demand higher in the longer term. But what I think the pandemic possibly does do, it could bring forward that peak oil demand by a couple of years. We've seen a significant cut in capex in upstream oil and gas. And so if this continues, it does leave the potential for the market being extremely tight several years out. And so the higher prices we see as a result would likely be enough to give some countries a renewed push towards greener energy.
Okay, Warren Patterson, ING's Head of Commodity Strategy. Thank you very much.
Thanks very much.
This podcast has been prepared by ING solely for information purposes, irrespective of a particular user's means, financial situation, or investment objective. The information does not constitute investment recommendation, and nor is it investment, legal, or tax advice, or an offer of solicitation to purchase or sell any financial instrument. Read more at think.ing.com/content-disclaimer.